Welcome. Today, we're diving into the world of options trading, specifically exploring a strategy known as the modified call butterfly. This strategy can be a valuable tool in your trading arsenal, offering a unique approach to navigating the market. If you're new to options trading, don't worry. We'll guide you through every step. Options can seem complex at first, but with a clear explanation, anyone can understand the basics and start using them effectively. Terms like strike price, which refers to the price at which an option can be exercised, and volatility, which measures how much a stock price fluctuates, can seem overwhelming. These are fundamental concepts, but we'll explain them in the context of this specific strategy. But today we'll break down the modified call butterfly strategy, demystifying the jargon and focusing on practical application. Our goal is to make this strategy accessible and understandable regardless of your prior experience. The modified call butterfly strategy in simple terms. We'll dissect its components, explain its purpose, and illustrate how it can be used to achieve specific trading objectives. This strategy is for investors who expect a stock to rise gently, anticipating a steady and controlled increase in price. It's designed to capitalize on modest upward movement, not skyrocket. We're not looking for a sudden, dramatic surge in value. This strategy thrives on predictability and measured growth. Think of it as a calculated plan with built-in safety, a strategic approach to managing risk and maximizing potential returns within a defined range, not a risky bet. It's about making informed decisions and understanding the potential outcomes before you commit your capital. The modified call butterfly lets you profit from a modest upward move, allowing you to participate in the potential gains of a stock without exposing yourself to excessive risk, while clearly defining your potential gain and loss, giving you a clear picture of the best case and worst case scenarios before you even enter the trade. This transparency is crucial for responsible trading from the start. This predefined risk and reward profile is a key advantage of the modified call butterfly strategy. It's a variation of the standard butterfly spread, a well-known options strategy that's been used by traders for years, tweaked for a bullish outlook. This modification makes it particularly suitable for situations where you anticipate a slight increase in the underlying asset's price. We'll explain the modification, highlighting the specific adjustments that differentiate it from the standard butterfly spread, and why it matters shortly. Understanding the nuances of this modification is essential for effectively implementing the strategy. The key: this isn't for explosive growth. It's not designed to capture massive gains from rapidly appreciating stocks, but for precise, moderate gains. It's about targeting a specific price range and profiting when the stock moves within that range. It's a tool for thoughtful investors, those who take the time to analyze market conditions and develop a well-reasoned trading plan, who want to align their trades with a specific market forecast, allowing them to express their market views in a controlled and strategic manner. We'll walk through the strategy step by step, breaking down each component and explaining the rationale behind every decision, using a real-world example. This will help you visualize how the strategy works in practice and understand its potential applications. By the end, you'll know what a modified call butterfly is, understanding its purpose and how it differs from other options strategies, when to use it, recognizing the market conditions and scenarios where this strategy is most effective, and how to set one up. You'll gain the practical knowledge and skills necessary to implement this strategy in your own trading account. The modified call butterfly is designed to generate capital gains, a one-off profit from a specific upward move in a stock. Unlike income or hedging strategies, this is a directional speculative play. You're betting the stock will rise. The structure involves buying and selling several call options, engineered to profit if your forecast is right. If your main goal is to profit from a rising stock price, this strategy fits. If you want income or protection, look elsewhere. Understanding this objective is crucial. It shapes every decision from stock selection to trade structure. Ours. For the modified call butterfly strategy to truly work its magic, a fundamental element is required. You must have a decidedly bullish outlook. This isn't just about hoping the stock goes up a little. It's about having a strong conviction that it will experience a significant upward movement. This strategy only profits if the stock rises, and not just a little bit. The more substantial the rise, the greater the potential profit, ideally to a specific target price. This target price is the sweet spot where the strategy achieves its maximum profitability. Setting a realistic and achievable target is crucial for success. The modified part of the name isn't just for show, it significantly shifts the profit zone higher than what you'd find in a standard call butterfly strategy, making it more aggressive and geared towards capturing upside potential, rewarding you handsomely for a move above the current price. It's designed to capitalize on a strong surge in the underlying asset. You need a clear and compelling reason for your bullish view, something more than just a gut feeling, like strong earnings that beat expectations, signaling positive momentum for the company, or a new product launch that's generating significant buzz and pre-orders, indicating future revenue growth. Do your homework thoroughly. Dive deep into the company's financials, analyze industry trends, and assess the overall market sentiment. And set a realistic target price for expiration. Consider factors like historical volatility and potential catalysts that could drive the stock price higher. If you're unsure about the stock's direction or expect it to fall or stay flat, perhaps due to looming economic headwinds, this simply isn't the right strategy for you. There are other option strategies better suited for neutral or bearish outlooks. The modified call butterfly is a specialist tool, not a one-size-fits-all solution. It's designed for a specific market condition, for a predicted rise, and a significant one at that. It's about capturing a specific upward move within a defined time frame. Your confidence in a bullish outcome is absolutely essential. It's the foundation upon which this strategy is built. Without it, without that conviction, you're just gambling, hoping for luck rather than relying on informed analysis and strategic execution. The modified call butterfly works best in low implied volatility. Low volatility means cheaper options, lowering your entry cost and increasing your potential reward. High volatility inflates option prices, reducing profit and increasing risk. This strategy profits from price movement, not volatility changes. Always check implied volatility before trading. Look for stocks with low volatility and a likely steady climb. Entering when volatility is low lets you risk less for more potential gain. Avoid this strategy in turbulent markets. It's built for calm conditions. Think of it as sailing on a calm lake, not a stormy sea. A major advantage of the modified call butterfly is knowing your maximum profit and loss up front. Your risk is capped at the net debit you pay to enter the trade, no surprises. No matter how the stock moves, your loss can't exceed this initial investment. Your profit is also capped, achieved if the stock lands at the strike price of the options you sold, the trade-off limited risk for limited reward. This structure forces you to weigh risk versus reward rationally. You can decide if risking, say, £50 for a potential £200 gain is worth it. It's a disciplined, business-like approach to trading. Defined risk and reward make this strategy ideal for building confidence. Let's solidify our understanding with a concrete example, and what better company to use than Apple Inc. AAPL will walk through a modified butterfly spread using Apple's stock, illustrating how this strategy can be applied in real-world trading scenarios. This example will help you visualize the mechanics and potential outcomes of this option strategy. Suppose Apple is currently trading at £208 per share. This is our starting point for constructing our option strategy. We'll use this price as the foundation for selecting our strike prices and evaluating potential profit and loss scenarios. Now let's say you've analyzed the market and you expect Apple's stock price to rise to £215 within the next month. This is a moderately bullish outlook, not expecting a huge jump but a steady increase. This expectation is crucial for determining the appropriate strike prices for our modified butterfly spread. Furthermore, you observe that the implied volatility for Apple options is relatively low. This is an important factor because low volatility generally makes options cheaper, which can improve the potential profitability of our strategy. Given this outlook, you decide to implement a modified call butterfly spread. The first step is to buy one call option with a strike price of £210. This is the lower strike price in our spread and will benefit if Apple's price rises above £210. Next, you sell two call options with a strike price of £215. This is the central strike price and the point where our maximum profit will occur if our prediction is correct. Selling these calls helps to offset the cost of buying the other calls in the spread. Finally, you buy one call option with a strike price of £225. This is the higher strike price and acts as a hedge against a larger than expected price increase in Apple's stock. It's crucial that all of these options contracts have the same expiration date, expiring in 1 month. This ensures that the spread behaves as intended and that the profit and loss calculations are accurate. The modification in this strategy comes from the uneven spacing of the strike prices, which differentiates it from a standard butterfly spread. This adjustment allows us to fine-tune the profit zone based on our specific expectations for Apple's price movement. Notice that the difference between the first two strike prices, £210 and £215, is £5. This relatively small gap indicates where we expect the stock to move towards. However, the difference between the second and third strike prices, £215 and £225, is £10. This wider gap reflects our belief that the stock is less likely to reach that higher price point. This uneven spacing effectively shifts the profit zone of the butterfly spread higher, aligning it with our moderately bullish outlook for Apple. Let's assume that the net cost to enter this entire modified butterfly spread is £1.50 per share. This cost represents the premium you pay for all the options contracts involved. Since each options contract typically represents 100 shares, the total cost for one contract would be £150. This is the initial investment required to implement this strategy. Now, let's consider the potential profit. Your maximum profit will be realized if Apple's stock price closes exactly at £215 upon expiration. This is the sweet spot for this strategy. In this scenario, your profit would be the difference between the £5 spread between the £210 and £215 strikes, minus the initial cost of £1.50 per share, resulting in a profit of £3.50 per share. Multiplying this per share profit by 100 shares per contract, your total maximum profit would be £350. On the other hand, your maximum potential loss is limited to the initial cost of the spread, which is £150. This is the most you can lose if the strategy doesn't work out as planned. Therefore, you are risking £150 for the potential to gain £350, creating a defined risk-reward profile. This strategy offers a clear and defined risk and reward, making it suitable for traders who prefer to know their potential outcomes in advance. This particular setup is well suited for a situation where you have a modestly bullish outlook on Apple and you anticipate relatively low volatility in the market. Ultimately, this modified butterfly spread provides a practical and structured way to translate your market forecast into a concrete trading strategy with defined risk and reward parameters. Remember, this example is for educational purposes only and should not be considered financial advice. Always conduct thorough research and consult with a qualified financial advisor before making any investment decisions. To open a modified call butterfly, use your broker's combo or spread order type. Enter all 4 legs as a single order to ensure proper execution and pricing. Specify your maximum net debit, e.g. £1.50 per share. Once filled, your position is live and your risk is capped at the amount paid. Make sure your account is approved for spread trading, as this strategy involves selling options. Brokers require this to ensure you understand the risks. Check your permissions before trading. This approach keeps your trade structured and your risk controlled. Have an exit plan before you enter. If the stock nears your target price as expiration approaches, consider closing early to lock in most of your profit. To close, place a reverse combo order. Sell what you bought, buy back what you sold. If the trade goes against you, your loss is capped at your initial debit. You can close early to limit losses or let it expire worthless. Monitor your position. Don't set and forget. Take profits when you've captured most of the potential gain, or cut losses if your thesis changes. Active management is key to success. The modified call butterfly is a structured, disciplined strategy for cautious bulls expecting a moderate rise in a low volatility market. Its main appeal defined risk and reward, encouraging careful planning and analysis. The challenge: you need to be precise. Maximum profit requires the stock to land near your target price. Transaction costs can be higher due to 4 option legs. This strategy suits investors who enjoy research, forecasting, and risk management. Practice with paper trading first and start small. It's a sophisticated yet manageable way to act on a bullish view. For the thoughtful investor, it's a valuable tool to add to your arsenal. So, good luck with your trading. Thank you for watching and see you next time.